Well, the U.S. Federal Reserve has reaffirmed that its massive mortgage-backed securities buying spree is going to end at the end of the month. With a look at how that could affect the U.S. housing marketplace, we're joined from Washington by John Weicher. He's the director of the Hudson Institute's Center for Housing and Financial Markets. He also ran the U.S. Department of Housing and Urban Development between 2001 and 2005, so-called HUD. John, great to have you here on the show.
Well, it's great to be here, but I've got to correct that last statement.
Oh, my apologies.
I ran the Federal Housing Administration, which is a part of HUD.
Okay.
I didn't run HUD.
Okay, fair.
The two men under whom I worked, you certainly did, and the two men who held that job at that time would be quite startled to hear that, and I don't want to get in trouble with either one of them.
Fair enough, John, fair enough. My apologies. Subject at hand, though, mortgage-backed securities, MBS is stopping those purchases. We've seen the Obama administration answer the declining housing prices with those kinds of initiatives, shoring up financing on the MBS side of things, as well as with tax credits. How would you describe the housing sector in the United States with all these initiatives in place?
Well, housing starts have been basically flat since around last June. We've been producing month by month at an annual rate that's between 575 and 600,000 units over the year. It dipped, I think, in October. Last month, when, of course, we had terrible weather in the northeastern United States and the South Atlantic area here in Washington and other places to our north and south, housing starts were basically flat from January, which was not so bad. And I think that is the most positive thing I've seen in the housing market, that it was flat during a bad month from the weather standpoint. But otherwise, starts have been flat for about 6 or 7 months. With all the incentives people have been trying to provide, we haven't seen any real improvement.
What's interesting, John, in just the weekly numbers, and granted it's a little bit microcosmic, but the multifamily dwellings were down in the most recent housing start numbers, and yet single family were turning up. Is that an indicator that things may be improving in the future?
I wouldn't count on that. Multifamily bounces. It's very volatile. It's very small. We've had a decline in multifamily housing going back a good 20 years to passage of the Tax Reform Act of 1986, which removed some of the tax incentives for building and investing in multifamily housing. A couple of months ago, we had the all-time record low in multifamily starts. It bounced up last month. It bounced down this month. Single family has been more or less flat, certainly moving with less volatility than the multifamily sector has.
Okay, John, the other thing that's interesting is that, these MBSs, the Fed kind of signaled a while ago that they were running out of MBSs to buy. So winding it down at the end of the month is not so critical. I'm wondering where the private sector steps in to reassure that part of the marketplace so that housing can improve and financing for housing can improve in the United States. Do you see that happening?
I think there's probably going to be some cautious inaction on the part of private investors at this point, private lenders. The Fed, I would imagine, has been testing the market by reducing purchases a little bit over the last few weeks, I would guess, in order to see what would be happening if they ended the program. And I think they probably have the view that there will be no particular effect on interest rates and probably no effect on the availability of credit. I hope they're right. They're likely to know more about it than most of the rest of us, but I doubt very much that there will be a big private rush into the purchasing mortgage-backed securities or making loans. The housing market is still very weak, and if the best we can say about it is that it's flat, I don't see any reason for investors or builders or lenders to jump in with both feet.
Okay, so John, does that increase the burden then that Fannie and Freddie have to pick up the slack, if you will?
Well, there isn't much more burden left for them to pick up, much more slack left. Fannie Mae, Freddie Mac, the Federal Housing Administration, which I used to run, have been a huge share of the housing market over the last year or so. And of course, by this time, they're all federal agencies. Freddie and Fannie are essentially federal agencies. FHA has always been a federal agency. And that's, I think, the bigger issue is what does the government decide to do, Congress and the administration decide to do with Freddie and Fannie, which I don't think anyone can believe that the current situation is a stable or a permanent one.
Okay, John, I was kind of hoping to get a kind of a warm, fuzzy feeling on housing in the United States from you, and I'm not getting that because you're saying it's flat and you're not painting a very pretty picture in terms of what Fannie and Freddie can do to help the situation out. What happens to the housing market in the United States if mortgage rates start to tick up? And they've got to at some point.
Well, I'm sorry I can't be warmer and fuzzier for you, but that's the way it is as far as I can see. I think that it will be a while before mortgage rates move up very much, simply because the economy is very weak. You don't typically see prices, including interest rates on mortgages, rising in a recession. So I'm not too worried about that. But I think in the absence of Fed support, there may gradually be some increase, but I think it will be more because the economy is starting to improve.
John, thank you very much.
You're welcome. Glad to be with you.
John Weicher. He's the director of the Hudson Institute Center for Housing and Financial Markets. And he joined us from Washington.